Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. You have some questions here that I think I should probably answer. It says, this is one that I always think about that I never hear anyone answer. And I have answered this or asked this question, posed it to, oh man, I don't think it was on air, Palisades Radio, Tom Bodrovics. It says, if we are at the same inflation rate, 7% to 15%, as we were back in the 1970s, and the only way to get them under control back then was to have Volcker take interest rates to 15 to 18%, knowing that it is impossible to take them that high again without destroying the economy. In your opinion, will we be in extremely high inflation for a very long time? No, I don't think so. And where, in my opinion, and the way that there's two things that drive inflation, I think. There's government spending that they did with the stimulus and all that stuff. That is government spending, and if it gets put into the system through stimulus checks or whatever, I do think that could potentially have some inflationary effect. The second one is through loan growth or credit expansion in a fractional reserve system. That is what ties into the thesis of the channel. And the thesis of the channel is if you go into an expansionary phase of real estate, which blows up your assets to loan against. So residential real estate, building new homes at greater quantities, means that in a fractional reserve lending system, that new loans are going against those homes, which is inflationary. It's expanding the money supply. It's a leveraging up of credit. And that is the driver of interest rates. So Volcker, I don't know if he actually pricked it. People give him credit, but Volcker may have gotten lucky. And the demographic ran out between the baby boomers and Gen X. So the real estate market is what came back down. And that demographic, the spending of the demographic. So there's a couple of other things too. You can have this expansionary phase, but at the same time of this expansion phase of real estate, which is really the demographic interacting with the real estate market and that fractional reserve lending system and that money coming into the system, they're also in not just home buying years, but they're going into their highest spending part of their life. So this inflation will be around because for a little while, because you're going into home buying years for a larger demographic, and they're spending more money on kids and buying stuff for their homes and whatnot. So that's where I think the inflation comes from, because it's a leveraging up. That's what we've seen in history. And if I were to pull up a chart for everyone, and hopefully I can find it pretty quick here. Here it is. Got it. Here's the chart. That is the annual U.S. housing starts from 1890 to 2015. And if you look at the 1920s, it ramped up in the housing starts. And you could say that the average here is about where this was squiggling around here. It's somewhere in this range down here is the average. And we went above the average, which is a higher inflationary period. It's a leveraging up in the 1920s, the roaring 20s. And then we came back down, and whenever it goes below the average, that's when you start to have a collapse. And that was about 1929. So our real estate market is what caused the crash of the Great Depression, in my opinion. It was the deleveraging and deflation from the 1920s in the real estate market. And they did a whole bunch of crazy loans up here in the real estate market. It was just like 2005, 6, 7, and that big boom with horrible loans. It was the same thing in the 1920s. And then when you look at kind of 1940s, mid-1940s and on, what we did is we went to an entirely different state there. This was a highly inflationary period as we worked our way all the way up here. And we created a new higher level of homes being built in the United States. And it's remained at that level for some time. So it's when you jump from one level to another level in new homes being built, in my opinion, where you get higher rates of inflation. And where we are positioned today is we're coming back up into an expansionary phase. We are short 5.2 million homes. That's the latest data that I've seen, which could drive housing starts quite high. And if the average is a little bit below 1.5 million, like if it's 1.4 something million, we got to go above that to work off that 5.2 million. It's going to take probably 5 to 10 years to do that. And it's going to be inflationary. It's going to be a higher rates of inflation than what we had in the past, given those new loans against those new homes. And each new home, I think it's around 80% gets loans against it. So this here, you can basically see your interest rates and what they do. They're going to bounce back and forth. And this is an increasing interest rate environment. This entire 1940s all the way to 1980 is an increasing interest rate environment because we went to an entirely new level of loaning. So much more credit in the system. It's a large leveraging of credit upward. And then we kind of collapse down into a declining type move. And the demographic came out of, the demographic wasn't as large as before with the spending. Their spending and their building of homes. So we went through kind of a phase with lower inflation. So in my opinion, I think it's just the demographic running out. I don't think Volcker did anything, because if the demographic was still there and we still had a shortage of homes and we still had to build a bunch more homes, inflation would have still been pretty high. And the people would have had the same response in the bond market. They would have said, I'm not going to buy bonds unless you give me a very high interest rate. So in my opinion, it's driven by demographics and the relationship of that demographic interacting with the real estate market. That's my opinion. That's what I've seen. And the loaning that happens, the commercial bank loaning against that demographic. It says, Andy, what are your thoughts on rotating profits from a topping commodity to one that has not taken off yet? Let's say oil goes to $200 or $300, compresses to below 10, and uranium is still cheap. Do you start trimming off oil and add profits to uranium? I'm assuming that different commodities will take off at different times. What's your plan? And I think they're going to go up at the same time. I think oil just starts off earlier and it will completely go over the uranium bull market for the liquidity event. So we've got supply demand, which is going to push these for a long period of time, but the liquidity in the system is what drives money to go into other assets. It's interest rates, and interest rates are driven by liquidity. Liquidity is inflation. So if inflation or liquidity comes into the system, people are going to see that and they're say, oh, it's a high inflation period. I don't want to hold bonds. I don't want to hold stocks because interest rates are going to go up because of the inflation. It puts it into a real negative rate. And when they see that, they're going to say, I don't want to invest in bonds and stocks, so therefore I'm going to take my money out of these assets and rotate them into these other assets. Then your ratios are going to, if this was stocks and this is the commodities, they're going to rotate as this money goes, swapping from this sector into this sector. And those ratios will change. So I don't think that we're going to be able to play one commodity to another commodity with the majority of the commodities. I think they're all going to go up very similarly. The one I think you can play is maybe the platinum to silver ratio, where platinum maybe can take off first, and I bet you silver will lag behind it, or gold. Silver or gold will lag behind it, or palladium. When we get towards 2008, 2006 time frame, actually, let me pull it up here quick, and we can look at it real quick. I can show you what happened last bull market in the ratios. And what I'm looking at is I'm looking at platinum, because platinum seems to be very sensitive to inflation. The platinum to gold ratio is one of the measurements that we use to see if we're in a market that is conducive for commodities. This is the platinum to gold ratio, zoomed way out. I gotta get off log here because it's a ratio. we're coming on down and we broke to the upside and we're doing a retest. This is like the optimal time to be buying platinum, in my opinion, or exchanging your gold for platinum. And we're probably going to see this ratio move on up, which means that platinum's going to outperform gold. And it's probably going to do it at a pretty good pace. The last bull market was from 98 down here. It took a little bit of working to get up, and then it shot higher, massively higher to a 2.31. So 1 ounce of platinum could buy 2.31 ounces of gold. If we're at 0.5 and we can shoot up to that 2.3, what you're getting is it's a pure purchasing power gain of more ounces. But you're going from 2.3 divided by 0.5, you're getting 4.6 times your metal, almost a 5x on gold. So if you buy platinum today and this ratio were to do that, I don't know for 100% fact that it will. It sure looks like it will by looking at that chart with a descending wedge and a break of the descending wedge. But you can get almost 5 times your metal in gold if you buy platinum today. So I think that's a very good bet, is to buy platinum. Now, a platinum to palladium ratio, we are still very, very cheap. And back in 99, 2000, where I would have been buying platinum and it went down on you, so I would have been buying all the way through this area of platinum. This ratio shifted quite dramatically all the way up to, at the end of the bull market, 5.5. So if this one, you can see a larger compression or expansion of the ratio. So this one is probably more favorable to do swapping with. So if we were to do that and we used 5.5 and we're at roughly 0.5, that is an 11 times your metal increase. So the expansion and compression of platinum to palladium is larger than gold. So gold is more steady. It's more stable than palladium, and we want the ones that shift and move. So palladium is a very good metal to do our shaken and bacon moves with in our ratio swaps. Now, I don't know if palladium is going to be used in lower quantities in the future. I don't know if this ratio is going to swing as much, but I would guess it would. I'm just guessing. And getting 11 times your metal buying platinum down here of palladium in the future would be an awesome move if it were to go back to 5.5. This is just saying that platinum is very cheap. And these ratios maybe even compress more than this if you get out of whack scenario. And perhaps these ratios are going to start to expand and go greater to the upside and greater to the downside over time. Platinum to silver ratio, we're coiling up right in the tip here, and we're at 43. And at the end, not at the end. So in 98, 99, we got a buy signal in platinum, and we would have and that only went down to like 60s. We rode it all the way up, and if you could ride it and swap it at like 150, that was a 60 to 150, a little over 1, or a little over 2, I mean. Then we go all the way to 40. And if we were to ride it back up to 160, or let's say 150 divided by 40, you get 3.75 times your silver. So if you buy platinum today, maybe you can get 3.75 times your metal at the top. And it looks like we could do that in a few years. So hopefully platinum goes up and silver remains low or underperforms if you are in platinum. So the best one out of these would be would go into palladium. And that's probably what I'll do and I used palladium last time. And then platinum's cheap against all the other metals. So maybe that's one that you could use for kind of swapping between these using the ratios. I don't think we're going to be able to play it with. I mean, you are going to be able to. You may or may not be able to play it with oil. And whatever you do, you want to get out of the highly leveraged one at the top. So if our ratio, here I'll go back to this one here. If your ratio of gold to oil, and we're going to look at the downside here Let's see if I can find it here. 2008 is when it really compressed down. All right, auto. So 08, it went all the way down to 6.6, 6.5 down here. This is where you want to get out. So it was at 10, it compressed all the way down to 6, and it's go time to get out of here. And in 08, in 08, we sell this. This was going to be an everything crash, but what would you buy at the bottom here? This went back to a ratio of 28, and it came all the way back down in the 2010s to about 13. It even got down to 12. So the ratio here, from 29 to 15 is about a 2. You compressed it about 2 times. Where I would have gone is silver. So if I were to do a silver, silver to oil ratio, I think this one's probably a little bit more crazy in 08 and 09. So you would have sold in 08 the ratio and bought silver right here in 09, and then the ratio would have compressed from 0.42 all the way back down to 0.208. That's about a double as well, because silver is pretty crazy, but so is oil. What about a palladium to? Let me see what palladium did. Palladium in 08. Wow, this might be a good one here. Palladium outperformed in 09. It came all the way back in 09. You would have bought palladium at 3.5, and palladium would have been the play for sure against oil. And then you saw, actually, this is a really good ratio. Because the reason it's so good is because palladium and oil go opposite of each other. Palladium does very well in disinflationary period times, it seems like, and oil does really well in inflationary times. So this is like a really, really good one, because we if you were to look at the bottom of 09 was like the disinflationary end, or the inflationary end was 08. So if you had swapped your metals in 08, you would have went from a 3.37. Let me see if I can get this in here and see the exact amount. Oh my goodness. You would go from a 1.96 all the way to a peak of 172. And then if you swap to oil here, you go all the way back down. We've gone down to a 12.29, but this is probably going to continue to compress all the way back down to like let's just call it 2. So 2 to, let's say, 130. Oh my goodness. This is a very 130 divided by 2, you'd have a 65 times increase of your purchasing power in oil. And then if you go all the way back down to, I don't know where this is going to go. It's probably going to go pretty low. Let's say it goes back down to 2. You would go back from, let's say, 130 divided by 2, another 65. So this here has the most, probably the most compression or leverage to a move that I know of, is doing a palladium to oil ratio. So I think if you guys are going to look at this, you want two assets that perform opposite. I would say palladium and oil are the most leveraged to each other in opposite directions. Uranium is too. So on the upside, in an inflationary environment, oil or uranium would do very well, and then palladium would be the one that you want when you go into a disinflationary period. Those probably have the most bang for your buck. Rhodium would be another one if you want to go full on crazy. Rhodium does really well in a disinflationary period. And some of this can be it could be skewed a little bit because palladium went up quite a bit when they increased the loadings and catalytic converters for emission standards. Same with rhodium and palladium. So that might have skewed this to one side, and oil also went down to like 0, which is a weird scenario. But usually it goes to like 30 instead of this large, crazy move. But that's one ratio to look at, is your palladium to oil ratio. That's kind of a weird one. It doesn't mean that this ratio will hold as large of a move to the upside or downside in the future. So we're going to have to figure this out as we go. But I think we can figure it out, and I think we'll have massive leverage moves to all this stuff. So that's the end of that question, I guess. I would say that the ones that you want to look at is probably palladium and the stock market. Palladium, stock market here together versus oil, uranium. Those are the ones that I would probably look at to do the swaps if you want the most leverage. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.